Welcome to this programme from Baillie Gifford, the latest in a series of webinars where we talk to the managers of the group's various investment trusts and funds. My name is Amy Maxwell of Citywire, and today I'm lucky enough to be joined in the studio by Rosie Rankin, Director of the Baillie Gifford Positive Change Fund. So welcome, Rosie. Thanks for joining me today.
Thank you very much, Amy. It's an absolute pleasure to be here.
It's so nice that you're here in the studio, in person. That's the way we like it. So I would like to kick off today by talking about this idea of profit and purpose going hand in hand. In 2022, thanks to the rapid change in the interest rate regime, we've seen a market environment that has favoured value or shorter term assets. Profits are harder to come by in this environment. Are investments with purpose simply now a luxury, do you think?
Oh my goodness, I'm glad you asked that. And I would take completely the opposite view, that far from being a luxury, that investments with purpose are going to be what drives future returns. So let me explain a bit. If you go back over the last 100 years, really, what has driven wealth creation are some big transitions that we've seen in the economy. So going back, you can see there was a lot of wealth creation around industrialization, for example. And then moving on to the middle of last century, you saw a lot of wealth creation around fossil fuels and mass production. Over the last 20 years, it's been a lot of tech that's driven that wealth creation. Looking out over the coming decades, what are going to be the big structural growth drivers? Well, I would argue that it will be solving things like the climate crisis. That isn't optional. As a society, we have to put in place the investments that will help mitigate climate change. We've got 8 billion people in the world now. We have to feed those people with nutritious and affordable food. And we also have to provide healthcare to those people. So far from being a luxury, I would regard solving those big challenges as absolutely fundamental, not just for us as a society, but also in terms of generating investment returns.
And of course, that growing population is also aging. So you talked there about the healthcare. I mean, that is a huge impact on our forward planning, and we need to be looking at that now.
Yes, absolutely. We're seeing that real demographic shift from a global population that used to have a very kind of broad base of younger people. And now demographics are such that there's much more older people. You're seeing this in countries, particularly such as India, which is now obviously the world's most populous country. But as their population ages, they're dealing with a much higher incidence of non-communicable diseases like diabetes, heart disease and cancer. And they have to have the health systems in place and the treatments and therapeutics.
So these are obviously very long-term structural issues that need to be solved. But can we spend some time covering the shorter-term issue, which many of our viewers will be keen to have an explanation for, is what has driven that shorter-term weaker performance over the last 12 months? The fund is down 5% compared to the benchmark, which is up 5%. So where is the strategy perhaps deviating from the market?
Yeah, I'm again really glad you asked that, because I am sure that is something on top of people's minds, looking at that shorter term performance and thinking, what's happened? Perhaps just to provide a bit of context, is that Positive Change is a concentrated portfolio. We invest in around 35 companies. And so we do expect to perform very differently to the benchmark. And over shorter time periods, that could mean we outperform the benchmark, or, as has been the case over the last 12 months, as you say, underperform the benchmark. So that's to be expected, but at the same time, we remain kind of firmly committed to outperforming the benchmark over rolling 5 years. So to answer your question, actually, what's caused the underperformance relative to the benchmark over the last 12 months? I would actually point to 3 main reasons. One is healthcare companies. And this can be frustrating because some of the healthcare companies in the portfolio have continued to do really well operationally, but have significantly weak share price performance. Secondly, it's companies that we don't own but are within the benchmark. And thirdly, there are a couple of companies, which I can talk about a bit more, which definitely have had operational challenges and weak share price as a result. Will I take each of those and just give you a bit more? Would that be
Let's drill
useful?
down. Let's drill down. Do you want to start then with the healthcare?
Yeah, absolutely. So a great example of this, and actually it's the company that has detracted most from performance on a 12-month view, is Moderna. Now, when we bought Moderna back in 2018, nobody had heard of it, but of course now it's a household name due to the COVID vaccine. What we're seeing with the market is that they're looking at Moderna and thinking, well, Moderna's success over the last 3 years has been driven by its COVID vaccine.
It's an abnormality.
It's an abnormality. And really that's their only commercial product. And looking out over the coming years, you can anticipate that revenues derived from that COVID vaccine will fall as we move from pandemic to endemic phase of COVID. Now, that's true. But I think what the market is missing is the progress that Moderna is making through its pipeline of other vaccines and therapeutics. So it has around 43 other vaccines and therapies in various stages of clinical trials. Mm-hmm. And particularly encouraging is their respiratory vaccines for RSV and their flu vaccines, which we can see are getting to the very latter stages of trial. But also during the course of this year, they announced very encouraging progress in their personalised cancer vaccines, which moved from phase 2 to phase 3 trials. So whilst we can see the logic in the market's assessment of thinking, oh, this is a company where their main product's revenues will decline, I think what the market is missing is this huge opportunity that Moderna have to successfully develop and commercialise all the other exciting vaccines and therapies that they have in development.
So essentially it's not a one-hit wonder, and actually those skills that helped it make that hit, it is using again.
Exactly. I mean, when we originally invested, it was long before COVID, so we had no idea that was on the horizon. But the reason that we particularly liked Moderna was the potential and the flexibility of their mRNA platform. So, and we can see that coming through.
Excellent. Okay, let's drill down then into another one. You said what you haven't owned. So, from what I understand, the Magnificent Seven is the headline here.
Yes, absolutely. So, if you look at what's driven the market kind of positive returns over the last 12 months, as you said, the Magnificent Seven. So that's companies such as Apple, Amazon, Alphabet, Meta, Microsoft, Tesla, Nvidia. Now,
I've got them written down here just to check.
And they have all performed extremely well and driven a large proportion of stock market returns so far this year. Within Positive Change, we own one of those companies. We own Tesla and have done since inception of Positive Change, but we simply don't have exposure to the other 6. So if you're comparing Positive Change's performance to the benchmark, that's part of the explanation.
Right, okay. And this idea that you were holding so-called kind of weaker companies, one such being Orsted, that's also been in the headlines recently. 2 failed US projects. The bosses behind that have been outed. So what's the story there?
Yes, so right at the start of our conversation, I mentioned this kind of this need to tackle the climate crisis, and of course part of that is thinking about renewable energy. Now, Ørsted, it is the world's leading company in terms of offshore wind power generation. It's a Danish company. But this year it's had operational challenges. It has announced a significant impairment, and that is due, as you said, to withdrawing from 2 of its projects. It has faced challenges around its supply chain, both in terms of rising costs and shortages within the supply chain, availability of tax credits, and the higher interest rate environment hasn't helped it either. So there seems to be quite a lot in there that you think, oh, actually, Ørsted is facing challenges just now. for us as long-term investors, what we want to do is take a step back and think, actually, we're happy to own a company through a period of short-term weakness if we think the long-term investment case is still intact. And we're doing a lot of deep work just now in terms of looking at offshore wind and also the potential for Ørsted to ask ourselves that very question is, what potential does Ørsted have over the coming years? So always thinking with that kind of forward-looking mindset, but it has definitely been a detractor to performance over the last 12 months.
But in the long term, you're convinced of its viability.
Yes, that's certainly where we are just now. But as I said, we don't want to ever be complacent about the potential of investment because, things change. That's the world we live in. So certainly doing more work to understand exactly what we think its potential will be over the next kind of 5 to 10 years.
Excellent. Well, I think we've got a great lie of the land there of what's going on within the portfolio. Let's now turn our attention to the term of greenwashing.
Yeah.
We hear it bandied around a lot. It's now well and truly entered the mainstream. Consumers and investors alike are becoming increasingly aware of the term and skeptical over companies' ability to deliver on its promises. So how do you and the Positive Change team ensure management is really kind of walking the walk on this?
Yes. In a way, I kind of welcome the focus on greenwashing because I think actually a bit of skepticism is really healthy. And actually what we want in terms of looking at our investments is to think we want clear evidence that companies are having a real world impact. And then we want to be able to present that evidence to our clients who, of course, are investing in a strategy that has two equally important objectives. So I think that that kind of guarding against greenwashing comes first of all from the research that we do before we even buy a company. And it goes beyond just looking at the numbers, those quantitative numbers that you can look at when looking at a company. So for example, we invest in an education company, Coursera, they run an education platform. Of course, we can look at the numbers in terms of the numbers of students accessing their products. But then you really want to kind of understand from management their intent and actually what students that they're targeting and the difference it can make. So I would always say within our research, there's a kind of quantitative base with a qualitative overlay. And then what we want to do is we want to kind of monitor and report on that. So we publish an annual impact report where we report on the impact of every single company in the portfolio in terms of what difference have their products and services actually had on the world. So making that clear link. And I think there as well, what's really important is you don't just want to cherry pick the positive impacts that a company has had. You also want to be transparent where a company's product has had a negative impact because we don't live in a perfect world. So we want to be really kind of clear and transparent about what changes companies are driving, but also transparent about any negative consequences of that.
And I suppose many of these companies are also early on in their journey, and there will be both positive and negative outcomes to their business practices. So it's the case of kind of that open dialogue with all of the companies to understand, okay, well, you are emitting X, but you are doing Y about it.
Yes, exactly. I think that's it. You want to see some progress in terms of companies. As you said, we invest in some earlier stage companies. And another example is we invest in the language learning app Duolingo. Many people listening today may have used that. They're really committed to driving accessibility of learning. But if you look at them in terms of their climate commitments and disclosure around emissions, they're at a very early stage in that. They haven't really made much progress, and we can encourage them to do that, because we want to see all companies in the portfolio having a kind of clear and transparent approach to their climate commitments.
Okay, excellent. Well, let's move on now to talk about idea generation, for which the fund has, I understand, 4 pillars. So social inclusion and education, which Duolingo would fall into one of those, environment and resource needs, healthcare and quality of life, and base of the pyramid. So in amongst those 4 areas, where are you finding the most opportunity right now?
Yes, well, do you know what? One fantastic thing, we were chatting about this before, is the opening up of travel again, and the fact that the team have enjoyed getting out to actually meet companies, speak to people on the ground, and really understand actually what is driving change and what's creating those structural growth opportunities that I mentioned. So we're looking in areas such as the energy transition. So that's not just in terms of renewable energy, but thinking about the electrification of transport, for example, and thinking about the kind of metals and minerals that we will need in order to support the energy transition. Or with base of the pyramid, the team have travelled quite extensively in India this year, for example, looking for opportunities, both in terms of driving good health outcomes, but also in financial inclusion. And then the area of health continues to be a really rich source of ideas for us. So one of the most recent investments in the portfolio is a Chinese company called Wuxi Biologics. Now, what they do is they are a contract research and manufacturing organization for the biologic drugs industry. Now, what does that mean? It means if you were anything from a very small startup biotech to a very large pharmaceutical company, you could outsource to Wuxi. So for the very small biotech companies, Wuxi would help you through that kind of research and development phase of your biologic drugs, and then help you kind of manufacture. For the larger pharmaceutical companies, it's often manufacturing at scale that they help with. So at the moment, for example, Wuxi have about 600 projects ongoing with different partners. So it's a really sort of exciting enabler within the biologics drug industry.
Okay, and the obvious question, maybe the obvious next question, it's in China. So we've had a lot of geopolitics around China and about supply chains. So what is the fund management's position kind of there?
Yeah. So when we think about China within the context of positive change, we absolutely want China to be part of our investment universe. China is home to 1/5 of the world's population, and when you look at big challenges that we're facing, such as climate change, you absolutely need China's participation in order to solve these big challenges. But of course, as you rightly say, we have to be mindful of the geopolitical situation. And when we're assessing any company in China, you want to think, actually, how is this company exposed to geopolitical risks should the situation deteriorate, for example, between China and the US. So you want to understand the company's exposure to that risk, and also how the company is kind of mitigating against the potential of, say, kind of increased sanctions. And then I think, and this is not unique to China, but would apply to any company in the portfolio, you obviously want to be very mindful of business practices and the company's approach to, for example, sourcing materials, so whether that's from an environmental consequences or human rights implications. So you want to be really mindful of that.
And I understand it is the only Chinese stock in the portfolio. So there is, I imagine, a huge amount of due diligence that has gone into this inclusion.
Yes. So, and this wasn't at all a kind of top-down view to be ex-China. But yes, we haven't had a Chinese holding within the portfolio for around about 18 months. As I said, that's just an output of where we found ideas. But yes, for any company, we conduct a tremendous amount of due diligence before investing.
And then staying with the kind of recent portfolio activity, shall we look at some of the companies that you have decided to part ways with.
Yes,
Some
of course.
recent sales.
Yes, really happy to talk about those.
I understand there's a couple here. So something that worked and something that didn't. NIBA.
Yes.
It's a European heat pump manufacturer. So can you tell us more about why you parted ways?
Yes, absolutely. So yes, NIBA, Swedish company, manufacturer of heating solutions, including heat pumps. And we've owned that since the inception of Positive Change, so going right back to January of 2017. And over the last 6.5 years, it's grown really pleasingly in terms of expanding production and growing revenues. Performed really well in share price terms, so returned about 400% for us. But of course, following that kind of period of growth, we need to ask ourselves, does it have the potential to double in share price again, looking out over the next 5 years? It's done very well for us in the past, but what about the forward-looking case? And this is where we felt our conviction was wavering in NIBA. Just in terms of thinking about that next phase of growth, it's going to be harder for the company. For example, they are trying to penetrate the US market, which is challenging. And also just looking at the valuation of the shares, it's starting to look quite rich. So yes, for a number of reasons, we've decided it's an investment that's done very well for us, but now we'd rather kind of deploy that capital in other ideas, such as Wuxi.
And there's a UK-based company as well, FDM Recruitment.
Yes.
So I understand it takes graduates and ex-military personnel and sort of finds them jobs. So where did things start to kind of unravel a little bit here?
Yes, and again, we've owned FDM for probably about 5 years in the portfolio. And we really liked it for the kind of social mobility that it was enabling. As you said, taking whether it's graduates or ex-military personnel, putting them through an 8-week training course and then placing them with a company where they would work for 2 years, at the end of which they may be taken on permanently by the company or can go and be placed with another company. So social mobility is a hard theme to address through listed equities. We always liked it from that perspective, but FDM has really struggled to scale. So over our 5 years of ownership, the number of trainees that it hasn't grown meaningfully. I mean, it has grown, but not scaled to the extent to which we'd hope. And looking forward, again, from that investment perspective, couldn't see that path for them delivering the types of investment growth that we would anticipate. But also, of course, that ties into the impact, because they were impacting a relatively small amount of people, whereas for both the investment and impact case to work, we would really have needed them to expand that trainee cohort to tens of thousands, rather than just, I think it was about 3,000 people they were training annually.
Okay, so a perfect illustration of that concept of impact and investment going hand in hand.
Absolutely.
Okay. I think now we kind of reached the end of our discussion here.
Yeah.
We could turn it over to the Q&A now, to our audience. So we have one question that's come through, and it talks about the title. It picks up on the title of this webinar, which is Why Positive Change, Why Now? So could you give us an explanation, Rosie, of why this fund now in particular?
Yeah, no, really happy to. So hopefully we've covered a bit about the why does positive change have a long-term kind of ambition, but actually why right now? And it kind of goes back to our overriding philosophy as growth investors, is that over the long term, it is companies' revenue and earnings growth that will drive share price performance. And actually, when you look at the companies within Positive Change right now, it's really exciting in terms of the revenue growth and earnings growth that they're expected to deliver. So if you look, for example, at forward-looking 3-year consensus for revenue growth, it's about 8% per annum. Now the index is sitting at about 2.5. Or if you look at predicted earnings growth, the kind of profitability of the company, it's predicted at 13% per annum over the next 3 years, which again is more than double that of the index. And you're looking at the companies and thinking, my goodness, they're kind of investing for the future as well. So across the whole portfolio, companies are investing in research and development at about twice the rate of the index. And they're not doing so by taking on a lot of debt, because the indebtedness of companies in the portfolio is less than that. So you're looking at a portfolio of companies where the fundamentals are looking really strong. And at the moment, we're not being asked to pay up for that. You know, in terms of those PE multiples of the companies, it's sitting at about 24, which is a historically low level for positive change. So it just feels really exciting.
And is that a key indicator that you look for, that R&D budget?
Yes, because what do we not want to see? We want to see companies who are really investing in innovation, because ultimately innovation is where we're going to see that kind of real driver of future returns. What we don't want to see is companies taking a lot of money back in terms of paying out dividends or buybacks. That's not what we want to see in terms of the company behaviour. We want to see them being ambitious and really investing in future growth. And it can also be a real indicator of intent, because not only is it the quantum of research and development, it's actually thinking, where are they investing this? What areas of their business are they prioritising for future growth?
Okay. We've got a few more questions here as we've been going through there. Chinese biological company, how do you ensure that their partner's IP is secure and protected?
Yeah, no, it's a very fair question. And obviously as part of our due diligence, we speak to the company itself, but we're also fortunate to have spoken to a number of WuXi Biologics customers. We've been able to access them because many of them are companies in which we invest through broader Baillie Gifford strategies, because we wanted to ensure that there were kind of appropriate policies and procedures in place in terms of safeguarding IP, but we also wanted to speak to their underlying customers just to understand what their experience had been in terms of using WuXi as an outsourcer, because that's obviously IP is absolutely critical within the biotech.
It's almost like you've reverse engineered the position then. You've kind of, from some of your other holdings across Baillie Gifford, you've understood what it's like to be a client of theirs, and then seen that it's...
And so it's that kind of cross-fertilization of ideas and research that can be really powerful and insightful for us. But I mean, that is a great question and kind of illustrative of the range of things we want to think about.
Yes. And of course, you cannot discount China as from the portfolio. It's going to be a huge driver. So
yeah, exactly. And so it's I think it's just in investing with your eyes open and just ensuring that. And of course, we're investing in the actual companies. That's what we want to invest in.
How many co-managers does Positive Change have? It's the view here is asking 5, and why so many?
Yes, again, well spotted. So yeah, we do like team-based decision making at Baillie Gifford, and so Positive Change is no exception there. The 5 is comprised of 3 investment managers and 2 impact analysts. And the reason for that split is that to get into the portfolio, a company has to meet our investment expectations. So we have to have conviction that a company can double in share price terms on a 5-year view. And we also have to have impact conviction that the company is genuinely contributing to a more sustainable and inclusive world. So to get into the portfolio, you need one of the 3 investment managers to say, yes, I believe that this company meets our investment hurdle, and one of the impact analysts to say, And yes, I believe it's contributing towards a more sustainable and inclusive world. So yes, the 5 really reflects the fact that our dual objectives are equally important to us, and we want that reflected in the decision-making group and right through the process, really.
And you could always have a majority in that regard, so I suppose 3 against 2 or...
Yes, to get into the portfolio, you just need at least 1 on the investment side and at least 1 on the impact side, so you don't need consensus at all. But you do need to have those 2 enthusiastic backers, and if the rest of the group were maybe less enthusiastic or uncertain, that would be reflected in a moderated position size. You put it in at a smaller position size. Whereas if there was kind of broader group excitement or enthusiasm and a higher level of conviction,
you'd size it larger.
You'd size it larger.
Okay.
But we want to a degree, we want to embrace uncertainty and embrace our colleagues' enthusiasm. So you want to...
So it's empowering
It
the
is,
managers.
yes. Yeah.
Okay. We have a question here about AI.
Mm-hmm.
It's obviously the hot topic of the day. Do you have a view on AI in terms of positive change? And do you have existing investments that you could describe as AI-driven?
Oh, that's good. Yes, it is topic of the day, and yes, I mean, I guess there is so much we don't know about AI yet, in terms of how it will develop and what its consequences will be. I think I can point to quite a few examples in the portfolio where it's already being used to good effect. So, for example, I mentioned Duolingo, the language learning app. So it is using AI now within its language learning app to facilitate conversations with the app. So if you're learning a language, you can start having conversations with the app and it will kind of respond based on your responses, and that is a kind of AI-driven product. So it's and to access that feature, although Duolingo is free to access, if you want that kind of personalized conversation, that's a kind of monetized feature within Duolingo. Or on a completely different topic, you have got a company such as Deere, the manufacturer of agricultural equipment, which is using AI within its precision agriculture technology. So again, AI is helping to inform a much more efficient use of chemicals and pesticides within agriculture. So those are examples of where we kind of see the positives of AI within companies within the portfolio. But I think it's at such early days for AI. We want to be really conscious as well of any potential negative consequences, either for our individual companies within the portfolio or society at large. So yes, I would say it's something that the team are having lots of conversations about and thinking about it in that both that portfolio context and the kind of larger societal context.
Yeah, I suppose it's obviously a hot topic, and regulation could be kind of incoming. So that's, I suppose, front and center of the fund managers' minds, and ensuring that you're kind of investing in things that you clearly understand and it's applied.
And it's understanding. I'm sure all of us don't yet appreciate the full applications of AI or where it can be used and employed, and it's just really starting to think about the different applications and how companies are utilising what is a very powerful technology.
Yes, yeah. And I suppose that it goes back to the idea of having constant dialogue within your portfolio companies and those close relationships within the management of the companies to understand where they're taking it.
Yeah, exactly. And of course, an application I didn't mention was within healthcare. Moderna, which I mentioned, uses AI within its mRNA platform as it's kind of developing various iterations of therapies. So again, the AI will probably affect all 4 of our impact themes, but be utilised in very different ways.
Yes. Okay. We have another question here about the makeup of the fund. It's very concentrated at 35 stocks. So how often do you decide what goes in and what goes out?
Yes, oh no, great question. So we all sit together at Baillie Gifford, so there's kind of constant dialogue within the team. We sit down formally once a week for a stock discussion where we'll be discussing a particular company. It might be a company that's already in the portfolio, or we might be discussing a new idea. And then every 8 weeks, we sit together and look at the whole portfolio to make that decision about actually what changes do we want to make to the portfolio. Are there any companies here that have maybe seen a share price fall but are doing really well and we want to actually add to that position size? Or are there companies within the portfolio that have done very well in share price performance and we want to reduce? Are there any companies here where we've lost conviction, such as FDM, and it's time to sell and redeploy that capital in a new idea? So yes, it's every 8 weeks for that holistic portfolio review, but we're talking every day. I guess that's what makes this a job so kind of interesting and enjoyable, is that there is constantly kind of developments.
And I suppose you're always having to ensure that you are you're not, what's that term, not falling in love with your stocks.
Yes, it's ensuring you're not falling in love with your stocks, that that there is we're really fortunate. We have a very diverse team in terms of expertise and interests, so there's lots of kind of constructive challenge. And then I guess one of the challenges as well is there is so much news and noise. I'm sure people feel this. It's often overwhelming in the amount of news that comes in, and it's distinguishing what is just noise and what is of material importance to a long-term investment thesis. Is really a sort of critical part.
And I suppose that Ørsted is a great case for that. You know, in the sort of, when you've got significant senior figures departing the business, you know, you have to kind of,
so that is obviously a very kind of material development there, and so you want to take the time to understand, so what next, and what does that mean for the long-term prospects of the company. And yes, as you said, kind of looking at the projects that they've withdrawn from, is that a kind of very sensible commercial decision, or is it indicative of something else that we should be concerned about? So yes, lots of thoughts to throw into the mix there.
We've got another couple of questions here. Given the risks in the macro environment of lower growth and tighter financial conditions, how do you expect the companies to perform given a more negative environment? How resilient are their earnings should there be a material slowdown? Yes,
and I think that's a good question, kind of, because obviously stating the very obvious, the macro environment has changed a lot over the next 2 years. I guess there's two parts to that question. One is thinking about the resilience of companies in the portfolio. And we've certainly done an exercise looking across the whole portfolio to look at companies to say, actually, what's the company's vulnerabilities to rising interest rates, for example? What does their balance sheet look like? How is this company positioned to cope with rising input costs if their input costs go up? What's the company's pricing power? You know, is it able to pass on increased input costs through the form of raising their prices, and will their customers be accepting of that? So we've done quite a lot of work around resiliency. Interestingly, for positive change, lots of these companies are doing something really fundamentally beneficial for their customers. So, you know, they're not typically a discretionary item, so their customers are typically really loyal and recognize the value of what the company is doing. But there was another part to that question as well, in terms of the kind of looking forward, how will companies do in an environment where, you know, access to capital is perhaps more restricted.
End of cheap money.
Conversely, we do wonder if that can be beneficial for some of the companies in the portfolio, because this end of free money creates more rational competition. In terms of the competitive environment, weaker competitors will fail, and actually it could create an environment where kind of well-run companies who are kind of prudently managed are able to kind of thrive, and you create an environment where there is kind of much more rational competition rather than companies being able to effectively buy market share through the kind of abundant availability of capital.
Yeah. So those who have built strong foundations will stand the test of time.
Yeah, that's
okay. A question here related to healthcare, which we've touched upon a few times throughout the conversation. Why is Moderna in top 10 in the trust, but not in the fund? So somebody here has got an eagle eye and been comparing and contrasting. So the fund, I'm not sure. Perhaps we could spin this in terms of Moderna and its holding across the Baillie Gifford kind of family of funds.
Yes.
And trusts.
So from that perspective, Moderna is widely owned at Baillie Gifford. There's lots of our investment teams who very much like the long-term prospects for Moderna. In terms of the exposure, because obviously we have the Positive Change fund, which we're talking about today, but we also have Keystone, which is the investment trust run to the Positive Change mandate. Moderna actually has quite a similar weighting across both the fund and the trust. It'll be about a 4% position size in both. It's maybe just marginally dropped out of the top 10 in the fund, but it will be around about a similar position size. But gosh, well done that.
Yeah,
whoever spotted that. That's
okay. So
yes,
it's
but that's not a sort of strategic decision to
Yeah.
have a lower weighting in the fund versus the trust or vice versa. I think it will just be a function
of the difference in structure, perhaps between the trust and the fund.
And certainly the trust has slightly more holdings because it has exposure to private companies as well. But yeah, there's no deliberate decision there to have a different weighting.
Okay, I'm glad we got to the bottom of that one.
Yes, that was a good question.
What has the capital outflow been over the last 12 months?
So in terms of inflows and outflows to Positive Change in general?
Yes, I believe so, yeah.
Yeah, they're really happy to talk about that. So if we look at Positive Change as a whole, both the inflows and outflows have been sizable. So in terms of inflows into the strategy, and apologies, I'm about to talk in dollars, which I know is really unhelpful for a UK audience, but the inflows into Positive Change have been about $1.3 billion, and the outflows have been $1.6 billion. So net negative flows of $300 million. Now, these are huge figures. I would say that the majority of inflows that we have seen have been from largely institutional clients, mainly in Northern Europe, Canada and Asia. So it's been really pleasing to have that support. But obviously there have been outflows as well.
And the institutional market, what they do, the rest of the market tends to follow. And also they are, in many respects, the leaders in responsible investing, given the fact that they are managing pension assets. So I suppose that is quite a kind of good bellwether for
it's
the
really,
attractability of the
yes,
fund.
it's really interesting to explore different motivations of some of those institutions. We have some charities and foundations who want to align their portfolio more with their actual philanthropic mission of their charity or foundation. So they want that stronger alignment. And then interestingly, with some of our pension fund clients, they're kind of thinking about fiduciary duty in quite a broad sense. So they know, number one, they have to be able to pay their members' pensions, of course they do. But they also want to give their members a world that they want to retire into. And so thinking about actually, they want that duty to think about actually, what do we want the world to look like by the time my member, who's in his early 20s, reaches retirement? So I was thinking with that multi-decade time horizon.
So the fund is really tied in with that mission.
Yeah, absolutely.
And also, I imagine from a valuation perspective, it's probably quite attractive at this point in time as well.
Yes, absolutely. And I think it's interesting because obviously we have seen over the last couple of years growth assets and growth equities being really kind of out of favour and having a very tough time. But it's interesting seeing some of these large institutions really starting to think, oh, actually, looking forward is now the time to reallocate to growth.
Okay. I think that's kind of all we've got time for. We're out of questions now. So all that's left to say is thank you for your time, Rosie. And
thank you.
Thank you to our audience for watching and for your many questions, which we've enjoyed just going through. With more sessions like this coming up, so do keep an eye out for those if you found today useful. Thank you very much.